Hello traders, welcome back to Nova channel and let's continue another new topic today. In today's video, I will introduce to you the liquidity and yield shock. Let's get started. First, let's explore why gold moves violently even when there is no news. Recently, many gold scalpers have experienced the same frustrating situation. The market feels calm, no major economic news is scheduled, and the chart shows a clean technical setup. You enter the trade with confidence, only to see gold suddenly spike, hit your stop loss with seconds, and then move in the exact direction you originally expected. Movements like this leave traders confused and frustrated, often questioning their strategy or execution. In reality, these moves are rarely random. They are usually caused by liquidity and yield shocks, two fundamental forces that every serious gold scalper must understand. To begin with, liquidity shock occurs when the market temporarily lacks enough buyers or sellers at the normal price levels. During these movements, even a relatively small order can cause the price jump aggressively. Gold, despite being a highly traded asset, liquidity can disappear during session transitions, short time windows before the major events, or periods when large institutions adjust their positions. When liquidity thins out, price no longer moves smoothly. Instead, it jumps from level to level. Spreads widen and stop losses placed too close to price are easily taken out. Importantly, these moves do not happen because the market has chosen a new direction, but because it needs to find enough orders to continue trading. At the same time, gold is extremely sensitive to movements in treasury yields, especially short-term and middle-term bonds, such as the US 2-year and 10-year yields. A yield shock refers to sudden and sharp movements in these yields within a very short period of time. This can happen due to bond auctions, institutional rebalancing, or changes in expectation long before any headline appears on the news. When yields rise quickly, gold is often pressured lower, and when yields drop suddenly, gold can spike upward. For scalpers, the critical point is that gold reacts to yield movement first, not economic news release. By the time retail traders read the explanation, the damage has already been done. Because scalpers usually trade with tight stop losses, liquidity and yield shocks are especially dangerous. In normal conditions, tight stops make sense. However, during these unsustainable movements, the market often makes a fast and violent move designed to clear cluster stop losses. This is why many traders feel as if the market is hunting them personally. In reality, the market is simply searching for liquidity. Once the stop loss are triggered and positions are clear, price often stabilizes and continues in the original direction. This explains why traders are frequently stopped out right before the real move begins. These shocks tend to occur at specific times of the trading day. Gold is particularly vulnerable during the London-New York session overlap, the New York Open, and around US bond-related events. The market may look quiet on the surface, but underneath, large players are repositioning. For a scalper who is unaware of these conditions, even a high-quality technical setup can fail repeatedly. This is not a problem of strategy, but of timing and market awareness. Experienced good scalpers learn not to fight the conditions. Instead of trying to be the first to enter, they allow the initial volatility to play out. They wait for liquidity grab to happen for yields to stabilize before committing capital. Often, the best trade appears after the market has already made its most violent move. This approach may feel uncomfortable at first, but dramatically improves long-term consistency. Your goal is not to catch every move, but to avoid being trapped during the most dangerous moments. In conclusion, gold does not move violently without reason. Where there seems to be no news, liquidity and yield shocks are often the real drivers behind sudden spikes and stop-outs. Scalping gold successfully requires more than reading charts and indicators. It requires understanding the market is fragile. Traders who ignore liquidity conditions and bond yields will continue blaming their strategy, while repeating the same mistakes. Those who respect these hidden forces, however, gain a crucial edge and dramatically improve their survival in the market. And that's just the topic today. Thank you for your watching. And don't forget to subscribe Nova channel to receive more useful video for your trading journey. Happy trading and see you in the next video.